So students, there is another important concept from this chapter with the name called trading on equity. अभी हमने डिस्कस किया था कि कैपिटल स्ट्रक्चर की जब हम बात करते हैं किसी भी फर्म के, तो कैपिटल स्ट्रक्चर में दो मेन बातें आती हैं. देयर आर टू कंपोनेंट्स mainly in the capital structure. One is D and the other is E. The debt is called the borrowed funds for the company and equity is referring to the owner's fund. तो ये डेट बोरोड या ओनर्स फंड इन दोनों में चॉइस होती है फर्म के पास. तो डी एंड ई दोनों मिलके कैपिटल स्ट्रक्चर कंपनी का बनाते हैं. नाउ अकॉर्डिंग टू दिस कॉन्सेप्ट ऑफ ट्रेडिंग ऑन इक्विटी, इट इज सेड कि जब जब हम अपने कैपिटल स्ट्रक्चर में अ कंपनी व्हेनेवर increases the debt component in its capital structure, it ultimately leads to the benefit to equity shareholders, or we can say the EPS for the shareholders get increased as debt structure increases in the capital structure of the company. But this is there is a condition to this phenomena students. Debt का कंपोनेंट बढ़ाने से EPS बढ़ता है, ये ठीक है, बट देयर इज अ कंडीशन अटैच्ड. कंडीशन क्या है कि जो ROI है प्रोडक्ट का, रिटर्न ऑन इन्वेस्टमेंट, it has to be greater than the fixed component of interest that is payable to the debenture holders. जब तक ये condition holds true होती है तब तक डेट को बढ़ाने से EPS बढ़ता है. Otherwise, if ROI becomes lesser than I, the fixed interest payment to the debenture holders, then no more the firm is said to be trading on equity. And उस केस में अगर हम डेट को बढ़ाते भी जाएं तो EPS बढ़ने की बजाय घटने लग जाता है. सो दिस इज द कंडीशन व्हेन ROI इज ग्रेटर देन I, द फर्म इज सेट टू बी प्लेइंग ऑन फेवरेबल फाइनेंशियल लेवरेज. फेवरेबल फाइनेंशियल लेवरेज का कॉन्सेप्ट यहाँ पे यूज़ किया गया है, या फिर हम कह सकते हैं दैट द फर्म इज ट्रेडिंग ऑन इक्विटी. That is, when ROI is greater than the fixed interest component to be paid to the debenture holders, increasing the debt component in the capital structure of the company ultimately leads to enhancement of earning per share for the shareholders. This is the concept of favorable trading on equity. And if in other case when ROI is less than interest, then it is no more the increase of debt component no more leads to increase in EPS, and this is called the unfavorable financial leverage, or the firm is not said to be trading on equity. So I hope it is very clear. It may be asked for as a 1 marker or maybe a 3 marker, so you should be prepared. On students, now let us understand this concept of trading on equity with the help of an example. सबसे पहले हम एग्जाम्पल के तौर पे दो कंपनीज ले लेते हैं, कंपनी A एंड कंपनी B, और इनके हम कैपिटल स्ट्रक्चर की बात करते हैं. सो इफ वी टॉक अबाउट द कैपिटल स्ट्रक्चर ऑफ द टू कंपनीज, इट इज नेसेसरली ईदर डेट कैपिटल और फॉर्म्ड ऑफ इक्विटी कैपिटल. नाउ लेट अस फिक्स दिस वैल्यू टू ₹20 लाख. हम ये मान के चल रहे हैं कि दोनों कंपनी ने 20-20 लाख रुपए के कैपिटल लगाया है. कैपिटल इन्वेस्टमेंट इनका 20 लाख रुपए है. अब या तो ये डेट से हो सकता है, ईदर इट कैन बी लेट अस से 10% डिबेंचर्स ऑफ ₹10 ईच, या फिर ये हो सकता है इक्विटी शेयर्स. इक्विटी अगेन एट द रेट ₹10 ईच. तो अगर हम ऐसा माने कि कंपनी ए ने बिल्कुल भी डेट फाइनेंसिंग नहीं करी, तो दिस इज जीरो इन दिस केस. देन एंटायरली 20 लाख रुपीज इज कमिंग फ्रॉम इक्विटी फाइनेंसिंग इटसेल्फ. एंड इन केस ऑफ कंपनी बी हम मान लेते हैं कि इन्होंने 10 लाख रुपए डिबेंचर से इशू किए और 10 लाख का इन्होंने इक्विटी इशू किया. इस तरीके से इनका कैपिटल स्ट्रक्चर में 20 लाख रुपए आए हैं. तो यहाँ पर इफ वी फॉलो द कॉन्सेप्ट ऑफ ट्रेडिंग ऑन इक्विटी स्टूडेंट्स, तो ए का जो कैपिटल स्ट्रक्चर में डेट बिल्कुल भी नहीं है, बी में डेट कैपिटल थोड़ा सा रेज हो गया है. इट हैज फ्रॉम 0 to 10 लाख रुपीज. तो ड्यू टू दिस रेज इन द डेट कैपिटल इन केस ऑफ कंपनी बी, द अर्निंग पर शेयर ऑफ इक्विटी मस्ट बी एनहांसिंग provided that condition is satisfied. And what is that condition? That ROI must be greater than the fixed interest I. इस कंडीशन को अगर सेटिस्फाई किया जाता है तो डेफिनेटली दे कंपनी बी मस्ट बी ट्रेडिंग ऑन इक्विटी. लेट अस कैलकुलेट नाउ ROI in this case. ROI, as you know students, the formula is earnings before interest and tax divided by the total capital structure. This is output, this is input. So it is a ratio of output versus input, and since it is in percentage terms, so multiplied by 100. Now EBIT, let us assume for both these companies as rupees 4 lakh. Just an assumption. And since the total capital is 20 lakh, let us calculate this ROI. It comes out to be 20%. तो 20% ROI है और हमने देखा 10% हमारा इंटरेस्ट है. Interest, fixed interest on debenture to be paid is 10% only. So if this condition is satisfied, ROI is 20%, however debt is only 10% interest on such debt. So we mean by this condition there should be favorable financial leverage and company B must be trading on equity. Now let us see with this an example and what are the calculations behind this. So again we are talking about the two companies A and B, and this is the capital structure we have seen, the two companies. And now let us see a few calculations. So first of all, we will start it with earnings before interest and tax. And this is what is also called EBIT. Then we must subtract the fixed interest from this. Interest was 10% on debt financing, because interest is always charged on debt. And then we will get something called earnings before tax, or in short we can write it as EBT or PBT. And then finally we are going to subtract the tax, which let us assume it to be at the rate 30%, to get earnings or profit after tax, what we also call as PAT or EAT. And finally this profit is available for distribution to the equity shareholders. So now EBIT, as we assumed, it is 4 lakh in both the cases. On subtracting the 10% interest, if you see this case, students, in company A there is no debt. However, in company B there is debt of 10 lakh rupees. So from this we can say that 10% interest is zero in case of company A because they have not financed from debt, and it will be 10% of 10 lakh, which means 1 lakh. This is 10% of 10 lakh that is coming from debt capital in case of company B. So interest is 1 lakh in case of company B. Now let us find out, students, that what will be earnings before interest and tax. So in this case it is 4 lakh only because no interest, and in this case it will be rupees 3 lakh. All the figures are in rupees. Now let us take tax rate to be 30%. So 30% of 4 lakh, it is always charged on profit before tax or earning before tax. So it is nothing but 1,20,000, and 30% of 3 lakh is nothing but 90,000. So once we subtract this, students, we will get something called earnings after tax, which will be 2,80,000 in this case and 2,10,000 in this case. Now you must be wondering that earnings after tax is lower in case of company B. Yes, that is true. But finally we have to arrive at the figure called EPS, earning per share, which means we need to divide EAT or PAT, after tax residual earnings, upon the number of equity shares. Now that will make the difference, students. In this case, if you see, we had assumed that all financing in case of company A was coming from equity only, and there were how many equity shares? 20 lakh was the capital, and each share is of 10 rupees. So we can say that there are around 2 lakh equity shares in case of company A and 1 lakh equity shares in case of company B. Now taking this in mind, their EPS will be calculated by dividing it with 2 lakh because number of equity shares are more in this case, and here it will be taken by dividing with rupees 1 lakh, the amount that is being financed from the equity. Now on calculation, students, you will get to know that here you will get the earnings per share as 1.4 rupees, dividing it, and here it will come out to be something like 2.1 rupee. So clearly it is evident that company B is having more earnings per share for the equity at the rate rupees 2.10 per share, and company A is having lower EPS of 1.4 only. This is just due to the fact, students, that company B has been financing using the debt component as well. They have also incorporated the debt component in their capital structure, that is making the difference ultimately and letting them to earn trading on equity or to live on the favorable financial leverage. But remind you, students, this is only possible till the point our ROI that we have calculated already in the previous slide. ROI is 20% and rate is 10%. So it is only possible till that point. If in case this rate exceeds the ROI, there will be no favorable financial leverage and the company will not be able to trade on equity. So I hope the concept is clear. Thank you.